Hello, good afternoon, everyone. Welcome to this NASSCOM webinar. We are here to discuss the implications of the proposals announced by the Honorable Finance Minister in the budget this year, which was held on 23rd of July. Now, all of you would have looked at the fine print and read through the various analysis that has come in. But what we're going to do today is to really have a expert panel to look at it from the lens of the technology industry. And I think that is something that we'll try to understand. And at the end of this, I think we will also be coming back to the government with some post-budget recommendations so that during this entire conversation, we can further give any inputs that we might want to. So with that, let me just have a quick round of introduction. So Himanshu Parekh from KPMG. KPMG does a lot of work as our knowledge partner on direct taxes. They have worked with us on a lot of the budget recommendations over the last couple of years. He is a partner at KPMG and head of taxation at the Western region. With him, we have Nidhi Kansal, who has been, I think, more and more on calls with us in building out a lot of these issues. And definitely on angel tax, we have had a lot of discussion and there is some good stuff there that we will talk about. From Deloitte, again, welcome Shefali. She is the chairperson at Deloitte India and really specializes in international taxation and has been our friend for long and been an advisor on many of these issues for the industry. Suchin, it's good to have this conversation with you here since we have been having all these meetings on particularly transfer pricing and safe harbor. So you get to talk about that, I hope, and it will be great to build that conversation as we move forward. And of course, Mukesh Bhutatni, who is the founder and managing partner at BMR. So Mukesh is a long-term NASSCOM friend and advisor. He is available to us whenever we have reached out for his expert advice. And with all these industry experts, we also have our special guest from the Ministry of Finance, Balasubramanian Krishnamurthy. As you know, he is Joint Secretary in the Tax Policy Research. He looks at anti-money laundering initiatives. And for the best part, I think he's also an IT industry veteran, so really understands the industry in and out. So we are very happy to have him. And of course, Mr. Vivek Agarwal. We have had many meetings with you in preparation and lead up to the budget. And I think it's a constant year-round exercise where not only on direct taxes and indirect taxes, we have looked at each of these policy issues with you. And as the additional secretary heading the tax policy research unit, you really give the policy direction to both the boards, the CBDT and CBIC. So I think right person for us to be listening to when we want to really decode what this budget really means. So that's really our panel. Welcome everyone. I am Ashish Agarwal. I lead the public policy function at NASSCOM. I get to interact with all of these experts, and I'm also responsible for putting the voice of the industry to the government and really driving the agenda of ease of doing business and reforms on behalf of the industry. And with me, I have my colleagues Ananya, Vartika, and Tejasvi, who do all the hard work of making sure that we really put together things in a way that makes sense. So with that, Vivekji, I could come to you first. Now, we have seen the budget announcements. I think there have been a few key wins as far as NASSCOM is concerned. And I want to say this, that it has been, in a way, a signaling for all the key sectors of our industry. So when you look at IT, BPM and GCCs, there has been ease of doing business. And there has also been talk of looking at the transfer pricing regime. This was also mentioned in the economic survey. So obviously, there is more work in terms of detailing out. If you look at the startup ecosystem, we have finally seen the abolition of angel tax, which I personally believe wouldn't have happened without your intervention, given your role in this policy formulation over the last nearly 3 years. And finally, if you look at the e-commerce, there is a whole set of rationalization which is there on the TDS side. And of course, the equalization levy, which went away, which is in a way a little unexpected. We didn't really expect that to go away. So it's a pleasant surprise and a positive one on that. So building on all of this, if you were to look at from a technology industry perspective, What is your message to the industry from a tax policy perspective? If you could share your thoughts, please. Over to you.
Thank you, Ashish. I'd also like to introduce Aseem, who is my colleague in TPRU and a very fine young officer who will contribute immensely to the work here. So, good afternoon to all of you, ladies and gentlemen. It's a wonderful opportunity for me to action with the industry stars from the technology. Actually, I mean, from the government perspective, if you see, the technology industry is the most important industry for India's economy. And whenever we're looking at framing any policy, which will have the key elements, as we have seen in the budget of employment generation, promoting research and development, promoting exports, creating wealth in the country, bringing in or retaining the best talent in the country. It ultimately boils down to the technology industry and the entire policy. The initiation point is always the basically the members of NASSCOM. So for us, you are a very, very important element or an important stakeholder in all exercises when we are framing policy. And this is since my tenure in revenue, I've been noting that the best suggestions to move forward have been coming from your side, and most of the suggestions we have been trying to build upon, to debate upon them, and then take it to policy decision makers so that we can reach a conclusion of those issues which have been raised. And as you would have noticed, and you, Ashish himself mentioned, that lots of major changes have been brought in this year's budget, which have far-reaching consequences, like abolition of equalization levy, reduction in the tax rate for foreign companies to have a more level playing field, of course, abolition of angel tax, which was quite a heartache, I must say, since last year's budget. Then, of course, there have been major issues which have been resolved from the ease of doing business perspective, which are not specific to technology industry, but it also applies to technology industry equally, like issues of reducing dependency of appeals, increasing the thresholds for filing appeals by the department before the tribunal, High Court, and Supreme Court, so that there is lower litigation and there is more tax certainty, reducing the period for reopening of cases, both for such cases as well as for reassessment, decriminalization of the TDS provisions, streamlining the TDS provisions. So all these measures are actually pointing towards a direction where government is going on a very definite path of providing a playing field to industry and to businesses, which is more friendly and which is more conducive to good business practices. And government is moving from the task of enforcement to a task of or to the system of partnership with the businesses. And compliances are more or less being expected to be on the self-compliant mode rather than a strong nudge from the enforcement authorities. So overall, the direction on the direct taxes side as well as on the indirect taxes side is to formulate a regime, a tax regime, which is more certain, which is clearer, which has less potential of litigation, and which relies on a trust-based system rather than going for too much of enforcement action. And it is a continuation of policy. I mean, this government brought in the faceless system of tax assessments, and it is following up. And the use of technology, both on the direct taxes side and on the indirect taxes side, is further creating an environment which is more business friendly and which is relying on a system which doesn't require the presence of the taxpayer or his consultant or lawyer to be present before any officer, because that is extremely important how the tax is administered. If you see the system of indirect taxes on both GST as well as on customs, there have been major changes that have been introduced. Just before the budget, we had the council meeting, and all the decisions of the council meeting were brought in the finance bill as part of the legislative process. So the consensus that was built with the states on many issues of GST, which were again friendly to the businesses, especially if you see the e-commerce industry, the TCS has been halved from 1 to 0.5%. So there is a clear direction for bringing the system which is very conducive to the growth of the country, and which is very conducive to especially to the technology industry. And if you see the schemes that have been launched in this budget, there may be schemes for employment generation, there may be schemes for apprenticeship, and there may be schemes for promoting new jobs by giving incentives to the industry. Technology industry would also be part of the same activity, and the talent pool that will get generated out of this employment generation schemes will also be a big plus for the industry to grow. So overall, if you see the entire theme is which comes out of the entire budget is pointing to one direction. That is, the direction is for igniting growth. The direction is for igniting employment opportunities. The direction is to give Indian youth an opportunity to not only find jobs but be entrepreneurs, to reduce all barriers for entrepreneurship, to generate and to attract more capital to the Indian startup ecosystem, and also to create a regulatory framework as we move forward, which is simpler in administration. And that is also reflective from the declarations or announcements that have been made. One announcement is on the transfer pricing and on expanding the safe harbor rule. So that is also pointing towards the simplification process that government wants to bring in. And the other announcement of simplifying the tax code again is a clear announcement to make it a simple administrative mechanism whereby the taxes are collected, but there is no harassment or there is no a problem for the business which is ready to comply and which is ready to pay taxes. Well, I think the direction is clear for everybody, and the government is totally committed to stay on the course. All of us who work in the government, it's very difficult to point out or to take credit by one institution or by one individual. It's a collective exercise that happens in the government and at all levels. The political leadership, the administrative setup, the overall country's leadership, they contribute to the direction of the budget. But so far as the team from the finance ministry is concerned, we have a clear instruction, we have a clear direction from the leadership, and we are staying on course. And you would have seen that it is not only a course for igniting growth, it is also a course for fiscal consolidation, which is continuing and which is coming out of the budget. So no country can actually have a growth in one industry, but the overall economy going bad. So the first task is, of course, to keep the economy on track, which is coming out of this budget very clearly by reduced fiscal deficit, by having a very good growth strategy based on capital expenditure, by having schemes which reduce inequality, which bring benefit to the last person of the society. So all those things have also been clearly spelled out in the entire budget exercise and the budget speech of Honorable Finance Minister of India. So our hope is to remain part of this a wonderful journey to make India Viksit Bharat, as we say. Thank you very much. We'll be very happy to take questions from the audience.
All right, great, Vivek. So one of the things we want to do through this webinar is to explore if there is any serious red flag, right? So we have experts and we'll have a conversation, and we haven't come across a serious red flag as of now. So we'll try and do that. And before I pass it on to our experts to give their comments, I just wanted to request you if you can elaborate a little bit on this proposal to simplify the income tax law. Because we have seen this exercise being announced or attempted before. We have a draft tax code which is a few years old. So are we starting a fresh exercise, or is it something which is a continuation of something which was done earlier? And as industry, how can we participate in this? Any thoughts on this would be very useful.
So the first exercise that has been understood that is required to be done is to take out the redundant provisions out of the code and make it a code which is up to date, rather than carrying lots of old provisions in it and keeping it very complicated and very voluminous document. The other thing that may be looked at, of course, the details will pan out as the exercise starts, because it's the starting point for the exercise. But as we understand, is that 3 or 4 key issues can be addressed in a short span of time. As I said, one is the redundant provisions to be taken out with a repeal and saving clause for any past action, but they need not be in the code, because there were lots of provisions which were built in for specific exemptions or specific provisions which have now become redundant because the timelines have expired. The other part is that there have been a lot of interpretations of certain parts of the code which have now reached a certainty, like there's a Supreme Court judgment on a particular aspect, or a particular language or a particular terminology is now settled as per judicial pronouncements. So that settled provisions need to be brought out clearly, so that there is no confusion for a common person to read. I mean, if you read the code, you should not be required to read the judgment as well to come to a proper conclusion. The third thing that could be looked at is how we number and structure the provisions without changing the essence of the law, and the language that can be simplified without changing the essence of the law. So primarily, if we start with this premise that the policy and the charging sections and the overall structure, even if that we don't touch, because if we change any provision, that will require a lot of debate and that will require a lot of to and fro. But if we just keep the policy, the charging and the procedure intact, but simplify the language and take out the redundant provisions, that itself will be a major exercise which will then keep a base or make a base for further simplification of the code as we move ahead. Because rewriting the code or trying to change the policy matrix of the code would require a lot of debate and require a lot of time. So that is my my own personal take. But of course, the entire gamut of activity that is going to come up and the way we are going to take it up will be structured as we move forward. And in next few days or few weeks, the exact methodology and the outcome that is expected out of that methodology would come out in the public domain. Till then, it's an internal exercise that is being done now, and of course, at an appropriate time, the entire expected outcome will be out in public domain.
Oh, no, thank you. I think that's a great starting point, at least when I hear, how do you structure this thought process and how can we, even within industry, can really think about it, because I think we should be doing our own parallel exercise within industry as to what is it that means. So with that, I just want to open up this discussion. So Mukesh, you heard Vivekji speak, and I know a lot of us in terms of the experts in the room have been through this exercise of looking at the income tax reform. So one, any comment on that from your side, and then second, on this important thing of angel tax being abolished. I mean, is it like one sweet announcement which has addressed the issues and it's done and dusted, or when you're talking to companies, are you hearing stuff? Are there concerns? Is there place for some more clarification and details that you would probably want to talk about?
So thank you, Ashish and NASSCOM, for inviting me, and thank you, Mr. Agarwal, for elucidating what actually is government envisaging by way of a new tax code. If I heard you correctly, it's not a redrafting exercise. It's a question of consolidating and putting it in a format which is easy to understand. Coming back to your question, Ashish, on angel tax, yes, to a larger extent, with the repeal of the provisions, it has been addressed. But I just wanted to give a little background so that I'm able to drive the point that there could still be certain issues that could come up from the past. And if I can make use of this platform to put forth some recommendations for the consideration of Department of Revenue. Well, this provision, first of all, is germane to times when the law was legislated in 2012, and it was introduced more as an anti-abuse provision, which was aimed for preventing round-tripping of funds. And initially, it covered residents, and this was followed by a set of what I would label as a complex valuation rules called Rule 11 UA. In fact, I was surprised that this law has already traveled to the courts, and there is also few decisions of the Bangalore Tribunal that came up. Now, this dispute, though came up in the context of angel tax, is capable of coming up in the context of any other part of the law which contains a valuation principle. So here the court was dealing with a situation where a valuation report prepared by a chartered accountant or a merchant banker, to what extent it is binding. The court ruled in favor of the taxpayer, saying that the revenue cannot reject the report unless a counter valuation report is produced. For me, this case was a lead case for looking at all forms of dispute that can arise out of valuation. I won't be surprised if, to the extent this rule applies from 2012 to 2024, there could be all forms of disputes that could arise. So I think we will do well by clarifying that if the rule presents itself an opportunity not for one, but for two valuation rules. It says that you have to take the best of two rules. One is Rule 11 UA, which will be either on an NAV basis or on a DCF basis. And second is the fair market value based on what is called the intrinsic value of the assets, which will cover both tangible and intangible assets. So it is very much possible that this will come up for dispute in the future as well. So if you repeal the law, this is an opportunity for you to take away the dispute that would arise when the law existed. Coming back to your question on the angel tax, obviously the whole issue of angel tax was given birth to when the government came out with its popular program, which is to promote entrepreneurship. And as a result of that, the DIPP came out with its list of accredited companies which fall in that category. And this was 2019, and immediately after 2019, the CBDT came out with a circular saying that businesses that are approved by the DIPP as forming a part of the startup program of the government would be excluded from the rigors of the so-called angel tax law. Well, I think the industry ask, and I have seen many NASSCOM recommendations, was that what if a startup is not approved by the DIPP? What happens to that? So that continued falling within the range of the angel tax law. And as a result of that, so much noise has been made by the industry. So that's another set of disputes that can arise. And then, of course, the last but not the least, I like the term Mr. Agarwal used, which was a 2023 amendment, when you actually extended the law under the garb of rationalization and said that it is not just for, it's both for residents and non-residents, which I thought was really the nail in the coffin, if I may use that word. So you have a law now which applies for 1 year, from 2023 to 2024. I thought that this was a good opportunity for you to repeal the law retrospectively. So if you can legislate the law, retrospectively, I'm sure you can repeal the law retrospectively. And I think by repealing it retrospectively, you will take away all the negativity that was built in through Finance Bill 2023 proposal. So this is your opportunity to do that. So I think all in all, sorry, Ashish, if I took a little time because you asked me a very pointed question. Will this put an end to the dispute? Unfortunately, my answer as a lawyer is no, it will not. And this is an opportunity to put an end to the dispute by taking away the retrospectivity from the law, by bringing out clarification on the binding nature of the valuation that the taxpayer produces, which is two valuation. One, as per the rule prescribed by the Income Tax Act, and second, what a merchant banker gives you. So this is my answer. I think the law is very much welcome. That's not like to take away the credit of being a very bold law. I actually looked at the statement and the best statement I could see was from none other than the secretary of DIPP, who's a serving civil servant. He said, so this was an ease of doing business issue as well as a tax issue. Ultimately, it is not a tax issue, but on investments, and investments should not get taxed. And he said this is genuinely a good idea, and he supported it, and that it will look at attracting more investment coming in from outside India. I just wanted to make a small point, related point. This has nothing to do with the angel tax, but there is a provision in the law which tax officials have been invoking, not as frequently as they invoke the angel tax. This is called the Section 68 explanation. So if my friends from TRU can recall, we added an explanation to Section 68 in the Finance Act of 2022 to bring loan transactions and all other forms of transactions. This Section 68 is being used by the tax officials at the field level to carry out adjustments in situations where both the borrower and the borrowed is not able to give a explanation, and this explanation is to the satisfaction of the officer. So it has created a deeming fiction where it says that if there is a loan or a borrowing and neither the borrower nor the borrowee is able to explain to the satisfaction of the officer, then it would be added back, and this is an opinion that needs to be exercised by the assessing officer. So I just thought I will make use of this opportunity to put forth that for the purposes of larger ecosystem of entrepreneurship and angel tax issue that we are talking about, this section is being frequently invoked by the field officers, and it's becoming a bit of a, if I may say, showstopper. Of course, we tend to look at this not when it comes to the officer, we tend to look at it when it goes to the tribunal. So I just thought I would make use of this opportunity to communicate my reservations on the Section 68 amendment, particularly the explanation that got added in 2022. Thank you, Ashish.
All right, thanks, Mukesh. Thanks for highlighting the concerns. So Vivek, what we'll do is that you might want to respond some of these things, but we'll probably bunch it together so that we get some feedback from others also. I want to come back on another specific issue, which I want to test out. Where are we seeing this as a set of experts from industry, and you're working with a lot of clients yourself. And I'm going to start by asking this to Himanshu first. So Himanshu, on this buyback of shares, the taxation, we have seen a bit of an oscillation in the hands of the shareholder, then shifting the burden to the company and now back. But when you look at the regime as it now stands proposed, I mean, and when you are speaking to industry, does this seem like a good place to settle down? Is there a sense of fairness in this regime? How does it? Do you look at it in terms of globally? Are we doing something radically different, or are we pretty much aligned? And then probably Shefali, I'll come in and get your thoughts on same, and then we'll build on one more question. Himanshu.
Thank you, Ashish. So firstly, I'd like to compliment the Ministry of Finance for coming up with a forward-looking budget, a budget which seeks to simplify the tax laws, curtail tax litigation, and facilitate ease of doing business. Now, coming to the specific question that you raised, Ashish, if we look at the regime which was prevalent until 2013, on buyback of shares, the shareholder was subject to tax on the capital gain which he made, and it was subjected to tax under Section 46A as capital gains tax. Effective 2013, the regime was changed. The incidence of tax then shifted from the shareholder to the company, and under Section 115 QA, the company is now liable to pay tax, the buyback tax, at the rate of 20%. Now, when we look at the new regime which is proposed in this budget, what it says is that any consideration received by the shareholder from the company on buyback of shares will be taxed as dividends. And it is not the amount in excess of the amount paid by the shareholder to acquire the shares. The entire consideration will be taxed as dividends. And the cost of acquisition of the shares will then result in a capital loss for the shareholder, and that loss can be offset against some other capital gain or can be carried forward. So just by way of a small example, let's say the shareholder acquired shares of a company for 100 rupees. The company does a buyback of the shares today at 130. The gain which the shareholder makes is 30 rupees. But the entire 130 will now be taxed as dividend, not 30, the entire 130. And the cost of the shares, which is 100, will be treated as a capital loss to be allowed to be either carried forward or set off against some other gain. One other very startling aspect of the new tax, if I may say so, is that this taxation by way of dividend is not restricted to the accumulated profits of the company. If we look at all the clauses of the definition of dividend under Section 2, Clause 22, in all the clauses, the reference is to restricting the amount of dividend to the extent of accumulated profits. But when we look at the subclause F, which is now proposed to be inserted, there is no mention of restricting this dividend to the accumulated profits. So even if the consideration is paid out of share premium, let's say, for example, even that will be deemed to be dividend, which is certainly at variance. When you look at reduction of share capital, for example, on reduction of share capital also there's a deemed dividend implication, and there's a capital gain or capital loss implication as the case may be. But there, the dividend amount is restricted to the accumulated profits, whereas here it is not so. And I don't know whether it's a conscious call or this is something which has been a miss out. So that's what the current position says, the new position says rather. Interesting situation arises in a case where the shareholder is where a shareholder is a non-resident and is governed by the provisions of tax treaty. And the question which comes up for consideration in such cases is that, will the shareholder be governed by Article 10 of the treaty, which deals with taxation of dividends, or will it be governed by Article 13 of the treaty, which deals with capital gains? And we had an occasion to look at the dividend article of some of the treaties. And the conclusion, the prima facie conclusion that we have come to is, in some cases, this consideration will tantamount to dividend under treaties, depending on the language of Article 10. Whereas in the case of some other treaties, it will not amount to dividend, that may be subject to tax as capital gains tax. The one other practical issue which has come up is where a shareholder, sells his shares under the open market through stock exchange route. So let's say a company wants to do a buyback of his shares, and the shareholder sells the shares on stock exchange under the open market through stock exchange route. In which case the shareholder does not know who the buyer of the shares is. And therefore, how do you practically implement this provision in such cases where the shareholder does not know that the shares are being bought back by the company, and that therefore the shareholder will tend to pay capital gains tax on the sale, assuming that the buyer is somebody else, some other buyer, not the company itself. So these are some of the interesting aspects as far as this provision is concerned. Now, Ashish, you also mentioned how do some of the other countries look at income arising from buyback of shares. So very quickly, we had a look at some jurisdictions. So for example, USA. In USA, the way they tax income from share buyback is that if this income qualifies under what we call as their safe harbor norms, then the income is taxed as capital gain. But if it falls outside the purview of safe harbor norms, then it is taxed as dividends. If you look at the position in UK, again, we've seen in some scenarios, the income gets taxed as dividends. In some scenario, it gets taxed as capital gains. But in either case, it is only the amount of gain which the shareholder makes, which is taxed as dividend or capital gains, not the entire consideration. Similar is the position in Netherlands, where the income is taxed as dividend, but only again on the quantum of gain, not the entire amount of sale consideration. So that's the position in some of the other countries other than India. Thank you, Ashish.
Thanks, Himanshu. That's pretty much a big point in some sense, right? So Shefali, in our industry, we typically, have companies sitting with large reserves. There is often buybacks and stuff happening. So do you have anything to add or comment? And then how does this probably impact the incentives in our industry?
Yeah, thank you, Ashish. So I think Himanshu is beautifully laid out in terms of how the law is going to change and what was the history of it. What I would like to add is that yes, this is a change, and with a little bit of tweaks, as Himanshu explained, if we are able to give that to the extent of accumulated profits, it may be deemed as dividend, and the balance be treated as capital gains, then I think pretty much we would look at a very stable regime, which is very comparable to the other countries, and then it can be the way forward. We don't really need to go and change the regime time and again. But let me also point out a couple of good aspects, or good fallouts of this change. Earlier, one of the concerns was that this buyback tax is paid by the company and it's not paid by the shareholders. Now, with this income being deemed as dividend in the hands of the shareholders, it is more likely that they may be eligible to claim the tax credit. If this is qualified as dividends and if the tax is paid by them as dividends, then they may be able to take the credit back home because it's a direct tax impact in their own hands. And then, of course, with the treaties coming into play, even the rate of tax might stand reduced under the treaty, which is, even better. And therefore, while the quantum of amount that will get taxed in the hands of the shareholders may be higher in the year of buyback, but the net tax impact may still be, reasonable. And yes, it is a timing mismatch because while, they will be paying tax on dividends in the year of buyback, they will get the offset for the capital loss to the extent of their cost of acquisition only in any subsequent years wherever they may have gained. So it is not an exact, matching of the cost and the gains arising in the same year. But I think these are some of the nuances. And then one more thing I would like to add in this context is that it is also very common for the private equity firms to subscribe to the redeemable preference shares and those type of instruments rather than equity. And the RPS, they are not redeemable or they are not bought back under the buyback provisions. In fact, they are redeemed under Section 55. So, they may not be again caught within that. And you have to look at the treatment as it may be arising now. So I think it's a good start. And with a little bit of fix, I think we should have a very stable regime on our hands. But at least, we've now tried to kind of align it so that, there is not too much arbitrage between declaring dividend and buying back. But if you allow me one more moment, I just wanted to go back to Mr. Agarwal. On the simplification of the income tax code, I think you explained quite well as to what we should expect. And that overall, the focus seems to be to rationalize all the provisions. Can we also expect that we will also look at modernization of some of the provisions? For example, there has been this talk about the tax consolidations or CFC or any such aspects which have also been, kept on cards, and along with the review of the income tax law, can we also expect some of those changes?
So let's do one thing. Let's take one more question, and then maybe we will request Mr. Vivek Agarwal to give his thoughts if he wishes to on some of these points. Because one of the other point that we have been hearing from industry is that on the capital gains, right? We have been as NASSCOM advocating for some of the rationalization. So, for example, which has been done that between a resident investor and a non-resident investor, there was a bit of a difference in the way the scheme applied, and now there is one scheme which is applicable for all. So that's clearly, one thing which I want to understand from our experts. How do they see this? And related to that also is that in startup, a lot of the funding mechanism happens through the convertible debenture route. So and then finally they get converted at some value, and then that's how the exit happens. So from a startup point of view, and more generally, when you look at the long-term capital gains and capital gains regime, how do you see this, Shefali? Is this looking more or less settled? And again, do you have any feedback already on this? And then maybe also Himanshu, if you want to add something on this, and we'll then probably go back to Mr. Vivek Agarwal on his thoughts.
Sure. So again, I think capital gains rationalization has been a long-standing ask. I think NASSCOM and all other industry players have been going and meeting with the officials to put forward the suggestions. So clearly, it is a step forward in that direction, reducing the number of the definition of holding period for long-term versus short-term, and bringing the rates together so that instead of a 10 and a 20 and a higher version, you have somewhere in the middle. There is a simpler application of the tax regime. So clearly, I think from a capital gains rationalization, this is along the lines of what was expected. But let me address the startup point first before I hand over to Himanshu to take us through the capital gains changes. For many startups, and especially when you don't know really how the companies are going to perform, looking at their business models, where they are in their growth cycle trajectory. Many investors do put in money in the form of compulsorily convertible debentures or optionally convertible debentures, depending again on the type of investors and what they're looking at. And now with the change in the budget, which says that any transfer, redemption, conversion, or maturity of these unlisted debentures will be deemed as short-term capital gains. And now this, while, for many other debentures and other instruments, the period of holding is going to change. But here, because everything is deemed as short-term, which is going to be taxed at the maximum marginal rate applicable to all the investors, it will see a significant impact on the investors as to how they view their investment into the companies. And this will also impact how the investors used to structure their earnouts from the companies. So whenever they would invest, and if there is any mismatch in terms of the valuation expectation, then the additional amount was always factored in through a convertible instrument. So based on the performance of the company at a future date, you would convert at a certain amount. But with this higher tax incidence, there may be an impact on how they are able to structure the earnouts as well. But with that, let me hand over to Himanshu to talk through the additional capital gains impact.
Just one additional point, as far as investors investing in unlisted debentures are concerned, or let's say compulsorily convertible debentures, if the investor happens to be a non-resident and is eligible for the benefit of tax treaty, then under most of those tax treaties, the capital gains on transfer of debentures is tax-free. So that was the position before this amendment. That position will continue even after this amendment, barring some of the treaties like US or UK, for example. Now, talking about the key changes proposed in this budget as far as the capital gains tax regime is concerned, Ashish, just give me a moment. I just want to flash one slide on the screen wherein we've captured all the key changes, and I think that will facilitate our discussion. Just give me a moment. Are you able to see my screen?
Yeah, if you could just make it full screen, it will be great. Yeah.
Yes, let me just do that. Is this better now?
Perfect.
Perfect. So first and foremost, this was one of the major asks of several industry forums, that the capital gains tax regime has become far too complex, and then therefore there's a need to simplify the tax regime. And that's an honest attempt being made by the government to indeed simplify this regime. And kudos to the Finance Ministry for coming up with the new norm of capital gains taxation going forward. Now, under the new norm, what would happen is that as far as the period of holding of assets is concerned, for them to qualify as long-term capital assets, in respect of all listed securities, if they are held for more than 12 months, they'll qualify as long-term capital assets. Whereas all other assets will qualify as long-term asset if they are held for more than 24 months. Now, there's one aspect that we need to bear in mind, and that is in the context of slump sale of business, which gets governed by Section 50B of the Income Tax Act. There, the period of holding still continues to be 36 months, and therefore there's a need to align that period also with the 24 months period, which is applicable to all other assets. As far as the rate of tax is concerned, when we look at the current regime, any long-term capital gain arising on listed equity shares or units of equity-oriented funds or units of business trust, under the current regime, tax is applicable at 10%. Now that goes up to 12.5%. If it's a short-term capital gain, under the current regime, it's 15%, which goes up to 20% going forward. In respect of unlisted shares, if it's a long-term capital gain today, the taxpayer pays 20% tax, but with indexation benefit if the taxpayer is a resident, versus a non-resident who is subject to tax at 10%. Now going forward, that rate will be 12.5%. And if it's a short-term capital gain, then it is a normal applicable tax rate which will apply. If it is listed bonds or debentures, under the current regime, there's a 20% tax which is applicable. Going forward, it will be 12.5 if it's a long-term capital gain, and applicable rates if it's a short-term gain. In respect of unlisted bonds and debentures, the current rate is 20% for residents, 10% for non-residents if it's a long-term gain. Going forward, as Shefali just explained, going forward, all the gains arising on account of unlisted bonds or debentures will be deemed to be short-term capital gains and will be applicable at the normal rates. And as far as all other assets are concerned, including residential property, as of now, the long-term capital gains tax rate is 20%. Going forward, that comes down to 12.5%. But of course, the 20% is with indexation and 12.5% is without indexation. And if it will be a short-term gain, it will be the normal applicable rates. So all in all, I would feel that indeed an honest attempt has been made to simplify the complex capital gains tax regime out here. From a personal tax standpoint, yes, there has been a lot of debate as to whether the 20% tax on sale of residential property with indexation, does it augur well for the investor versus the 12.5% without indexation? That's a debate which will continue. But from an overall perspective, I think clearly this new regime definitely is far simpler as compared to the current regime.
Great, thanks, Himanshu. Maybe we can remove the slide.
I will.
Okay, I think while we were talking about capital gains, some of our audience pointed us to the fact that markets have reached an all-time high. So I think that is just a digestion of various things which are happening over the last few days. Mr. Vivek Agarwal, you heard some of our experts, on three important points: angel tax, buyback, and capital gains. So just wanted to check, is there any comment from your side today? Because when we are tracking at least the media and newspaper, we heard Finance Minister being quoted that given the fact that now the angel tax provision has been abolished, then it would have an effect on naturally on how some of these litigations might also be looked at, or disputes might be looked at, because it can't be that on one end the law has been abolished and then on the other hand we continue to pursue something which we have kind of sensed is something that is not required. So would that be a correct sentiment to catch, and is there a merit in not leaving it to that kind of a thinking and really hard coding it in a way Mukesh, for example, suggested? And similarly on the buyback, do you think that we have arrived at a good place, or this entire idea of taxing the entire amount as dividend is something that perhaps is something that as a process will continue to be discussed?
Ashish, I'll take all the 3 points one by one. As regards the angel tax, last year when the resident and non-resident distinction was removed, there was a protest by the industry, and there were a lot of representations that were received, and there was a certain relief that was given because certain jurisdictions were notified, and investments coming from those jurisdictions were also then again included in the notification for exemption from the angel tax. So a lot of relief was already given last year as well. There may be some litigation that may be there, or there may be some assessment that may be going on. But as all the experts would understand, that law is applicable as the law should be applicable. So thinking that the law will not be applicable from the perspective of the legal principles and the dates from which it is applicable is slightly unrealistic expectation. But of course, government always takes into consideration the various opinions and voices coming out of the business and industry. So I think the current situation is what it is. I mean, as it is apparently there with the introduction of the finance bill. But of course, as we move forward, there can always be a reconsideration, and the leadership has the role and ability to take a call. But so far as a professional opinion is concerned, I think the law stands as it is, and if there is any change that can come, that will come. But we should not interpret it in any other way or have any unrealistic expectations of the legal provisions. So far as the buyback of shares position is concerned, see, when we were discussing about treating it as a income from dividend, we were also discussing about the examples from other countries, US, Netherlands, UK, where also it is treated as a dividend income, but with a differential method. But whenever we try to have a safe harbor principle or a differential regime, then again we are looking at complicating tax provision. So wherever we have these kind of provisions, we will be adding more complexity to the setup that we are trying to create. So when we are trying to create a tax certainty and we are trying to create simplification of processes, it is better that there should be one rule that becomes applicable. And in any case, the capital loss that is there, that is whatever is the cost of acquisition, is available for setting off against any capital gains in the same year or in the and can be carried forward. So I mean, more or less, so far as the shareholder is concerned, he is being realistically taxed. So I don't think there should be too much read into it, and we should not look at too much of complication. Of course, there is a logic. The logic is there, what Shefali was saying, that it's the accumulated profits, or what Himanshu was saying, which should be looked at. And they should be linked to whether we treat it as a dividend income or treat it as a capital gain. And that is what some of the jurisdictions around the world have done. I don't deny the logic. But then sometimes if we are looking at logic, I mean, many of the complex provisions of the tax code are on the face of it logical. But when we are trying to apply that logic in real life situations, it becomes very, very complex. Of course, it was logical to have tax on round tripping. That was the so-called angel tax. But then the application of that law becomes so complex, and the objectivity goes away, and and there is a need for simplification that comes for debate. So, to my mind, the provision has to be seen when it becomes applicable, and we have to see how it pans out. Of course, the tax laws are always dynamic. If there is something which really seems to be illogical as we move forward, government can always take the opinion on board, and corrections can be taken up. But to my mind, currently, we should look at more from the perspective of certainty and simplification and straightforward interpretation, rather than trying to make it more complicated. One point Shefali had raised about the code simplification, another aspect that was being raised. So in fact, if we look at all the exercises that have been done in the past, we have tried to achieve too much and have ultimately I mean, we have been left with almost the same situation, except for one major change that this government brought out. That was the faceless system of assessment and bringing in technology. So that was a big change, that the resolve of this government, which could bring that change in the tax administration and tax system without actually changing the overall code. But still the code complexity stayed, because even if with the faceless, the code complexity stayed. So to my mind, let's take small steps and try to reach a level which becomes a foundation for maybe larger ambitions to be achieved. So that is, of course, my personal opinion. I'm not stating that would be the government's stand. So my personal opinion is that let's take small steps. Let's take those 3-4 small steps where we are not challenging the policy, we are not challenging the essence of the law, but we are trying to make the law itself simple for everybody to understand, and more concise, rather than winding language, too many provisions, too many AA, BB, ZZ, ZZA type of things that are there, and make it more comprehensible to a common man. And then, of course, as we move forward, there is always a case to further simplify things for the businesses. So that bridge we should cross when we at least reach a certain level of simplification. And that is my personal take on that. So far as capital gains issue is concerned, Himanshu very nicely brought out all the provisions which will now be applicable. And it is well said by him that at least a major step of simplification and clarity has been achieved by bringing these provisions. The only issue is about, I mean, the debate is on indexation. There is no other debate. I mean, there is There is no other criticism, there is no other debate. But I can tell you that whatever is done, there is always more to be done. I mean, I always say that development or regulation, simplification of regulation, or the next level of development is always there. I mean, no government, even if you see US or Western world, would still be talking of reform. So reform will always be a buzzword, and there will always be scope for some improvement here or there. But as everybody has recognized, this is a major positive step. This is bringing out much more clarity in how the capital gains regime has to be implemented. It is much more simpler, it is clearer, and to a large section of society, it is giving relief, because the general feeling is that the tax rates have been rationalized and brought down in a major way, and too many classifications and too many differential interpretations have been taken out. So I think let's see how it pans out. And as Ashish pointed out, that within 2 days the market has touched its highest level with the revisions of the budget. So the actual impact of the budget, I mean, the initial understanding may have been different, but the actual impact of the budget is being seen now, or the provisions that have been brought is being seen now, and the market is also reacting positively. So I think it should be taken in the positive light, and let's see how it folds out. And to our mind, it would be a very positive development, both for the investors as well as for the market.
Thanks, Vivekji. I think there is a sense of pragmatism in terms of how you have responded, and definitely I think on the capital gains, at least there is, if I can say so, for a group, there is some sort of a consensus in terms of saying that okay, it seems like we have reached a good place, and of course we can improve. I know Mukesh, you had raised your hand earlier. But okay, if it was not to those topic, we'll definitely come to you. One thing, Vivekji, again, I want to go back to you, is that, and I mentioned in the beginning maybe that the equalization levy being abolished came as a pleasant surprise, and over the last 2 years, as an industry body which works globally, we had been part of conversations where in a global setting, few of the countries who have come out with this as a unilateral measure, it wasn't seen in a very good space. So now, obviously, we also understand that this is related to the implementation of the OECD global taxation regime, but we didn't hear really in the budget on the roadmap for global anti-base erosion rules. Or is that something that we should expect to hear immediately soon? Because it doesn't have to be in the budget. We as NASSCOM have been interacting and giving industry inputs on both these aspects. We have been working very closely with the Ministry of Finance, and that experience has been quite fruitful. But there is a set of questions we get from the industry because they do see this as a very complex exercise in terms of not only getting through to a consensus and implementation, but also really internally as an organization, how will they adapt to it? So there is a transition aspect to this also. So any thoughts on this that you can share with us?
So Ashish, the debate, discussion, and negotiation on the tax, international taxation is a continuous process. I mean, we are always engaged at the OECD and in the international discussions, both for Pillar 1 and Pillar 2. And the teams keep on working on where India should reach. But it always depends upon how the other countries and other jurisdictions are responding, and how our international understanding and standing is so far as the sovereign interests of the country are concerned. So equalization levy, of course, was taken out with a very clear policy direction. And so far as the direction towards Pillar 2 is concerned, it is still being debated, and India is taking its own position. We are looking at the overall industry scape in India, our future growth prospects, how investments are panning out, how Indian businesses are becoming global. I mean, there are lots of Indian technology companies which are now having global presence. So we have to really look at the entire picture in a more comprehensive way. So setting out a timeline or setting out a clear direction is very difficult for me to say at this stage. But yes, the department's teams are working diligently. We are always in negotiation. But I don't think we can set a timeline on the way forward. But India is always committed. India has always been committed and been a very responsible partner in the international tax discussions. And I can assure you that we will not be wanting, but whatever action or whatever decision is taken would be in the broader national interest and in the interest of the Indian industry. We will not compromise on the interest of the Indian industry and the sovereign interest of the country. But I cannot set out a timeline for this.
Okay. Then again, one issue which I thought was very close to our industry, and we really made a push for this as part of our advocacy with the government, and we had detailed conversations with the ministry, and those were quite engaging and useful. We did hear both in the economic survey and in the budget the call out to simplify and reform the transfer pricing, the cross-border transfer pricing, and particularly also look at the safe harbor regime to make it more inclusive in terms of participation. And now, having said that, because it is how we are reading it is that it is an understanding and acceptance of this requirement, but there is one interpretation could be that now we could really move fast, quickly, and frame a set of rules and a scheme which could potentially see the light of implementation over the next few months. On the other way could be that, oh, the announcement has been made, but there is a lot of debate and discussions ahead. So we would have to wait and watch, and as an industry, we can't really anticipate when we will see anything out of this. So I'm just putting these two scenarios. And before I come to you, Vivek ji, Suchin, you have been driving this work with us on the industry side. So what do you think could be? Do you think that there is complexity ahead when government would like to reform it, or given the work that we have done together with the industry, do you see this fairly, or if I were to say, not such a complex thing anymore to try and address? I mean, what would be your take as an expert first?
Thank you, Ashish, and thank you for the opportunity, and hello, everybody. Appreciate the tenor of the budget to expand the scope of ease of doing business, the whole matter of expanding and making more attractive the safe harbor rules is a welcome proposition for GCCs that are increasingly setting up operations and expanding their operations in India. There are two mechanisms to prevent disputes in the area of transfer pricing, one of them being APA and the other being safe harbor rules. Safe harbor rules are rules that are promulgated in order to allow for the transfer price to be accepted by the department, provided they stay within the norms of prescribed definitions. The existing safe harbor rules had two fundamental limitations, if you may. One of them was that they were restricted to a turnover of 200 crores in respect of IT or ITS. And second, that the markups were high, relatively high, from the standpoint of a mix of services, and these services therefore led to confusion around whether or not one could opt for those safe harbor rules, especially in respect of software development, where rates varied between 18 and 24%. We now have an opportunity as a result of a lot of a change having come about in respect of technologies, and a lot of the definitions having been having outlived their utility, to recast these rules to make them more current and more ready for a much larger GCC footprint with a much larger scope that could be possible. To this end, it would be useful, of course, to have some draft rules come through so that industry can comment, as opposed to bringing out a set of rules. Although I do recognize that if we were to make this applicable for financial year 23-24, then this would have to come out by September at the outer. But if it was going to be more forward-looking, then it is possible that it could be 24-25 onwards, in which case there's more scope for deliberation. I think from a global standpoint, we've seen rates of safe harbor in the region of between 5 and 10%. While we recognize that these rates need to be conditioned for the Indian economy, but we do also recognize that we are competing against many other locations that are the subject of GCC interest, and therefore it would be optimal, given the low risk nature of these GCCs, to be some position somewhere between the 35th percentile and the median, and therefore a range that is in the region of between, let's say, 14 and 15% may be optimal, given that we are seeing these as being outcomes that arise from MAPs, from bilateral APAs, from tribunal rulings, and of course, statistical analysis. I think the key is for us to also consider whether we could use the safe harbors as a potential opportunity to reduce litigation in the context of an assessment. And therefore, just as you have an updated return that has a small premium attached to it, whether these safe harbor rates could also be potentially rolled back into an assessment, and therefore at a small premium, a taxpayer could go into an assessment and offer up a safe harbor. So much of this is also conditioned on certain of these definitions that were written up as a result of Circular 6 of 2013 that defined insignificant risk. We've moved since then considerably due to the growing capabilities of GCCs, and therefore, to that extent, the rules may have more latitude going forward. But I'll turn it back to you, Ashish, and to Vivek ji for comments.
Yeah, so I just add one more thing to what Suchin just said. There is a huge potential in this GCC market, and the way some of the operations are getting organized is that more and more kind of contract R&D work is coming in or can come in, and sometimes the companies go and market to say that there is a little bit of India or there is a lot of India in our work. And then they worry in our conversation that if they were to go out and say that, then the taxman will come in and say 25% margin. So I think what this is doing is that in the larger scheme of global competitiveness, it is really making the GCCs little uncertain. And I think now this announcement has been made. So relaying back to my question in terms of how do we see this, and to Suchin's point, any thoughts, Vivek ji?
I've been personally involved in so many debates on the reform of the transfer pricing structure, and many of you, we've had one-to-one debates here. So the first thing I would like to say is that it's a major positive development that it has come as an announcement in the budget itself. So that shows that now we are committed to have a reform which is clearly towards expanding the safe harbor rules and trying to do it in a way that it reduces litigation and it brings in more certainty for global businesses. So the point that Suchint made is actually the correct point. It's the right direction. I mean, professionally, if anybody thinks about the simple reform that is required or simple change that is required, that is clearly the direction that Suchint pointed out. A certain percentage, 14, 15, 16, whatever it comes to as per the empirical evidence coming out of various APAs and MAPs, and also looking at having a small premium over the regular safe harbor rate, and then putting it in assessments and closing the assessment so that there is no point in litigation going beyond a certain level, or a complete certainty to they accept and they are within those safe harbor rules, then they don't have a sense of insecurity as far as opening up of assessments or transfer pricing assessments coming up their way. So I think the direction is very clear. The thinking from the policy side as well as from the side of the professionals is aligned. The time is ripe. The commitment is there in the budget itself. So one can look at a quick resolution of this issue. There is a strong support for simplification and creating the mechanism quickly rather than being too late about it. So I'm very, very positive about this particular aspect of the budget declaration. And I can tell you very clearly that Honorable Finance Minister is a hard taskmaster for all of us. So once she has made an announcement in the budget, we better follow it up and deliver it to her. So I don't think there'll be any let up from our side or from the leadership. So we should be able to come out fairly quickly on this issue. And I would almost totally agree with what Suchint had presented. And I think that is the way forward.
All right, great. So Suchint, that makes our task easier. We know what we want to ask, and I think there is equal enthusiasm from the government to take it forward. So we will at least not waste any time. We should be landing up in the ministry over the next few days and try and see how we can close this fantastic announcement which has been made in the budget. I know I'm conscious of time, but there is so much to cover, and there is one or two things particularly that we don't want to miss. But I would request, therefore, Nidhi, we have been doing this entire TDS rationalization, and that's where NASSCOM documents become bulky because they kind of go on and on in terms of ease of doing business, specific measures. But I think it's a great credit that we have had discussions with both Mr. Vivek Agarwal and his team, and in fact, the entire revenue department, that they've taken the time to listen and debate each of those points with us. So from that point of view, when you look at the overall TDS framework, are there loose ends? Are there things for forward future that you want to use this opportunity to kind of bring to light, and maybe will be, as we have been getting all of this candid feedback, maybe we can quickly also get a feedback.
Sheesh, thank you very much for the question, and thank you for having me on the panel. So let me start by saying that India is probably the only country which has such an extensive withholding tax legislation. Almost every transaction is covered under withholding tax net. So that's commendable. So I don't think there's any transaction which is left out. Even salary to partners now has been brought under the TDS ambit. So every transaction where withholding tax has been left out, in every budget, we see some provision coming in which expands the withholding tax applicability on those transactions. So that's commendable. This is a very important tool for our government to really garner revenues in advance on a real-time basis as the transactions are happening, and it is helpful from the perspective of really ensuring that department gets the revenue. This budget, as Vivekji has clearly highlighted, has actually focused on rationalization, simplifying the TDS sections. There are actually 3 baskets where the TDS provisions have been simplified in this year's budget. More certainty has been provided to the taxpayers. The first basket is really, rationalization of the rates itself. 194.0 in NASSCOM's biggest task has been that there should be simplification of, applicability of 194.0 provisions. At least we have seen a positive step towards reduction in the rate for TDS, which is required to be applied by e-commerce operators. From 1%, it has been brought down to 0.1%. Also, there has been TDS rate rationalization for different sections, wherein 5% rate has been brought down to 2%, like for commission, brokerage, etc. What this really helps is, it helps the recipient of the income manage their working capital, provides them liquidity, also reduces the cases where the recipient of the income would actually go for lower withholding tax certificate. So this actually, the reduction in rate actually helps in reducing the administrative burden, both on the side of the taxpayers as well as on the side of the revenue. So this will really help in terms of managing the refund situations, unnecessary refund situations where the money gets locked up with the department. So this is a very good move. Also, the proposal to really allow assessees to go for a lower withholding tax certificate in 194Q transactions itself is a welcome step, because there were a lot of cases where the taxpayers were in losses, but there is still a 194Q applicability. So that's very encouraging, that the revenue is actually listening to the practical realities on the ground and simplifying the withholding tax legislation. Apart from that, if you see the long-standing demand of NASSCOM, which has been there for the past 2 years, with respect to setting off of TCS, which happens by virtue of the TCS collection, which happens because of the remittance, etc., under LRS. So that has also been given heed to, and now there is a proposal that can be adjusted out of the TDS from salary. Though we would like to highlight that there is a drafting glitch in the proviso to section 192, and the proviso still restricts the employer to reduce the tax deductible on the salary with the TCS which has been collected from the employee. So barring that, it's a fantastic effort in terms of really bringing a lot of rationalization on TDS provisions. Also, if you look at the prosecution provisions, that has been diluted to a great extent. This was a very big problem for the companies, wherever there was even a minor delay in deposition of TDS. The prosecution cases used to get flagged in the department system. The change which has been proposed in the law of ensuring that of really giving a leeway that if the TDS is deposited, if TDS for a particular quarter is deposited by the due date of filing the return for that quarter, prosecution proceedings will not be initiated. That's a very big relief. So there I think it's a bold step by the department by really coming out with such kind of relief measures. Also, there has been certainty now given to the payers of the income wherever there are non-resident transactions, as the time limit now has been proposed in the law for completing assessing default proceedings, even in those cases where the payments are being made to non-resident payees. So for both non-resident payees as well as resident payees, now the time limit stands at 6 years from the end of the financial year. So a lot of certainty will definitely come as far as withholding tax compliances is concerned. This is a very good sign even from a transactions perspective. The mergers and acquisitions which are happening in this space, these limitation which comes in the law, the timelines, the clarity on the timelines which comes in the law really helps with the deal activity. So while it's a commendable job as far as rationalization of all the TDS measures are concerned, but so still there is, as you said, that there is always a room for doing something additional. There is still a lot of things which we can make to make the TDS provisions further simplify. For example, there is still a lot of debate on which places 194Q gets triggered or 206C1H gets triggered. There is an overlap because it's difficult for the assessees to really know what is the status of the other person and which section should really become applicable. Also, the tax collection statements which are required to be filed under 2060(1)(h). Those are very cumbersome and requires to feed in a lot of information which is not available with the with the tax collector. So that is also something which we can look at further simplifying. Also, the debate of what is professional, what is technical services, debate of 2% versus 10% still remains. And the obligation to issue withholding tax certificates in all the cases probably is redundant, and maybe we can look at rationalizing that provision also once we are looking at revamping the income tax code. But so with all that, I'm assuming that few of these things can probably find place in the the simplification that we are doing for the direct tax code. But apart from this, I think it's a fantastic attempt on simplifying and giving certainty on the tedious related aspects. Yeah, so with that, Ashish, I'll hand it over back to you.
Thanks, Nidhi. I think the glass is half full, but it is a good half full glass. So I think yes. So what I wanted to do in the fag end of this is, one, I just wanted to highlight one aspect for Vivekji, and then probably a quick 30 seconds from everyone, whether you have a question or a comment, and then give maybe a few minutes to Vivekji to respond. We will overextend by 5 minutes, but I think we can probably benefit from that. So given that we have seen some good proposals, sometime as industry association, once we have attempted certain ideas for a few years, we kind of give it up. We think, to nahi hoga, right? So, but we have seen that it is never to say never kind of a thing. So one of the things that we have been pursuing is on this ESOP taxation in the hands of the employee, where we have been really talking about to say that, why don't we just have it at the point of sale? Because it really becomes a cash flow burden. And we know the government hears us, and you have done this thing where you have said that, okay, let's give them 4 years or some time periods, but it doesn't solve the thing. So we have tried to figure out what is the big problem here in terms of, this being abused in some sense, but we haven't figured it out. So is there a merit where at least for government to say that, we are still looking at it, or is this, how motivated we should feel to come back to you with these issues? So that's just one example I wanted to leave for you. And before you come in, quick thoughts, anyone, and I'm happy if you don't have any quick thoughts also for the rest of our speakers. Anyone, any comment?
So Ashish, if just on the dispute resolution, so not particularly on ESOPs, and that I think we would wait to hear back from Vivekji, but on the dispute resolution scheme that has been announced, I think there were just 1 or 2 things where, the previous scheme was a huge success. 100,000 crores in demand was actually settled through that. 53,000 crores was collected. In the current scheme, there are a few places where what was available or what was already covered in the previous scheme has not been covered. So things like where the right to appeal is still live, but the appeal has not yet been filed. Can we cover those kind of cases as well? Or where the appeal or the case has been set aside and it is back with the assessing officer. Can we cover those cases? Also, some waiver for the secondary adjustment. I think if you are able to make some of these tweaks, it will really go a long way. And lastly, I think there has been a lot of on-the-ground challenge in terms of trying to deal with the CPC while giving effect to some of these, settled dispute cases, where there is nobody to speak to, and there is an auto adjustment of refunds, which has led to so many writs being filed. So if we are able to designate some people who can then, talk to the taxpayers and resolve these cases, I think that would also be very helpful.
All right, great. Suchint, I see you have a hand here. I thought you were very happy, but you have a question. So is it to do with domestic transfer pricing?
No, it's actually to maybe just taking up from what Shefali said, but there was a mention on a overall, if you will, of the transfer pricing assessment process. And this might require some substantive change in law. it may go into faceless mode, and if it does, then how does one build around safeguards to make sure that the taxpayers' voices are heard in a highly fact-intensive space? And if that means that it allows for collaboration and discussion with the revenue on the matter, then we would be pleased to hear from Vivek ji about it.
So, Vivek ji, I was in Bangalore yesterday, and we were having a conversation with a lot of deep tech startups. And you know, the problem in deep tech startup is the funding pipeline across stages is not really built out in India. And everybody was very excited with this announcement on Space Tech Fund, though we don't think it's a very large fund, but it's a good start, 1,000 crore fund. So I just wanted to flag this issue to you, that there is a need for deep tech patient capital, and government has a role. And we are in that inflection point today in India where we could really scale up our deep tech ecosystem if government steps in with the private sector. But that's just a thought I thought I'll use in this webinar. But over to you for your final thoughts, Vivek.
Thank you, Ashish. Actually, it's been a really interesting and quite a gratifying debate today. So I'll take up a few issues that have been raised and then try to conclude. Of course, as you know, on TDS, we had worked very hard, and we had built a certain set of proposals as a kind of an independent advisor to the government, and we tried to make it even more. I mean, we were trying to go all hog, and we've achieved a lot. So, as Nidhi was pointing out, a commendable progress has been made, and there may be some more issues to be settled, but the direction is clear. From my perspective, we want to reach a level where there should be no need to file a return on TDS, and everything should be very clear and set out. And there should be no need for actually reconciliation, which should happen automatically, and the processes should be so simple. So the target from our side was that. So we have achieved a lot, but I think it's a good journey on which we have started, and probably we will reach a level where the rate rationalization or the number of rates become very manageable, and these distinctions that were pointed out are not required. If you have you have only one rate or two rates, then all these things become more simplified. Of course, you can't have one because there are certain rates which are very, very small. Because the issue was that what's the purpose of withholding tax? Purpose of withholding tax is that the transactions get accounted for, and there is a widening of tax base. That is also one of the major objectives of the withholding tax. And there should be rational taxation, so that there is the need for refund should be least possible. So these were the main objectives for bringing out the reform. And why should there be criminal prosecution or even a threat of criminal prosecution for any unintended mistake that has been made or any unintended delay that comes in? So lots of issues have been addressed, and hope is that if there is anything still to be addressed, which will always be there, as I said earlier, we would be on the right track to do it. So far as the ESOPs issue is concerned that Ashish you raised, for startups, of course, the regime remains the same and there's no issue. But for other businesses, the sunset clause now comes up. But this is a very conscious decision that has been taken, because when you're looking at taxation and revenue issues, there are certain hard stops that are there. I mean, because ultimately our job is to collect tax, and our job is also to make sure that the escaping income from tax should not be there. But this is a conscious decision. But of course, we are always open to debate. As you know, whenever issues have been raised by the industry association or by the experts, we have done our best to come to a logical conclusion. The point raised by Shefali on Vivad Se Vishwas scheme is there are very relevant points. Last time also when the scheme was notified, Asim was telling me that there was a very long FAQ that was issued. So a lot of doubts were clarified and a lot of issues were settled as the scheme was implemented. So hope is that once the scheme starts getting implemented, so some of the issues that are being raised now will get settled as we start implementing it. And the hope is that more and more taxpayers will take advantage and we will have a major impact on reduction in litigation and collection of dues. So the hope is that, and it's a very well-meaning step that has been taken from the government side, and we really would like to push, and we will also seek your support to have the success of this scheme. And you can be our ambassadors, and of course, the glitches that are there, or if there are any clarifications that are required to be done, that the board will be very eager to do it, so that as we move forward, we are fully successful. There are practical issues on faceless that have been raised. The issue of the CPC, the man behind CPC, the issue of a call being taken up and addressed. So these are very core issues of administration that we are addressing on day-to-day basis. It's not that we are oblivious to it. These issues are coming to us even on the other public grievance redressal issues, on regular assessments, the issue of giving a full opportunity, giving proper time for response to the taxpayer. So these are being addressed on day-to-day basis, and we hope to reach an optimum level, because so there have been debates. I mean, there have been debates about the faceless system and the shortcomings of faceless system. But the government has been steadfast, and it has been a major reform that Honorable Prime Minister and Honorable Finance Minister brought in the country to bring this system. So it's our job to make it more potent and to make it more effective and take away the deficiencies that are there in the system. So that is how we are working on it. But the effort from the side of the administration is to make it more rooted and make it a system which is sustainable rather than sliding back on it. So that is the main focus for the faceless system. TP assessments going faceless, of course, if you ask my view, I would really be a votary for it. I would go for it, and that is, I think, the way forward. But how we will reach it, and what is the timeline of reaching it, and what will be the steps, that of course we have to move towards it. But let's hope if we have the rules set out clearly, more simplified processes, then probably we can look at it. So Suchin's point is well taken, but still it's not something that that is on our first priority, I would say. But of course, that is something that should happen. And Ashish, you made a very good point about the deep tech and the need for investment. Either it is a facilitative role that the government can play, or actually the role of bringing in capital. So government is very, very keen to make sure that India remains a leader on the technology front. Wherever there are gaps, the line departments are stepping up and coming up with programs, schemes, filling in the gap, and also they act as facilitators. Of course, that is not primarily the role of the revenue department, but we are alive to it. And as you would have seen, the entire focus of the budget announcements, which were made by the Honorable Finance Minister, were really focusing on bringing India up to speed on the latest technology and on research and development, and also partnering with the private sector on the R&D front. So not relying only on the institutional framework within the government, but also leveraging the private sector. So of course, the space tech and the other issues on R&D and technology are right at the top of government's priority. I have attended many meetings and many discussions I've seen where even the top leadership, Honorable Prime Minister, he has been focusing on this aspect. So industry should rest assured the leadership is totally aligned to this thought and working towards achieving this objective. Overall, I would like to conclude by saying that that it's a very positive budget this time, and it's the direction is very clear. It's a budget which will sustain India's growth, even accelerate India's growth, and it is a budget which will lead us to have a legal regime which is hassle-free and growth-oriented for the businesses as well, and especially for the technology sector, because technology sector is our lead sector. And in the last 2 decades, you have led India to a situation where India is, and for many more years, many more decades, you have to contribute to make India the leading economy of the world. And this is the only path to Viksit Bharat. And the path goes under your patronage and under your fast-moving leadership. So we would, from the department, we would love to continue working with you. And as you have always been interacting with us, we will hope to keep the interaction on and keep on doing whatever is required to be done to keep up to the speed. Thank you very much. I see Himanshu's hand raised. So before I conclude, if Himanshu has to say anything.
One more, I just wanted to bring one more point for your consideration, Vivek ji. And this is in the context of several corporates who have got huge number of appeals pending with the faceless CIT appeal administration since long now. We have had clients whose appeals are pending for as long as 10 years. And despite sending so many reminders to take up the cases, we've not seen any movement thereon. There are cases where submissions have been filed long back, hearings have happened, but we've not seen any disposal of orders. In fact, clients keep on receiving notices every few months from the faceless administration asking the client to file the submissions where submissions have already been filed. Despite that, notice comes every 3 months. So if something can be done to expedite the backlog of all these pending appeals of corporates, especially with the faceless CIT administration.
No, this is a valid point that you have made, and this is something that we are alive to. This problem is something that is right on the top of our agenda. You would have seen in the budget announcement also the pending litigation, especially pending appeals. There was an announcement by the Honorable Finance Minister about having more officers dedicated across different hierarchies for the disposal of appeals. We are also looking at differentiating the high-value cases from the low-value cases so that we can expedite the disposal where it is the amount involved is higher. So the process is on. Of course, it's an administrative work that we are doing at the level of the board, and the Revenue Secretary himself is taking a lead so that we come to a conclusion. But yes, it's a problem. We recognize it, and we are trying to resolve it.
Thanks.
All right. Okay, Mukesh, do you have?
If I may just add one more ask in basket of Vivek ji.
Okay, last word to you on that.
Which is the BAR. The BAR has to start delivering. Many applications are outstanding.
Yes. I mean, I have to concede, we are, of course, aware of this issue as well. But rest assured, I mean, this is again, I take it as one of the asks as given by you. But we'll do our best to resolve this issue as well. And I must thank all of you that it's been a great debate and a discussion. I hope to carry on with it. And I look forward to many more personal sessions also, and many more public sessions like this as well. Thank you very much. Jai Hind.
So, Vivek ji, if I were to conclude this session from our side. I think this has been very engaging conversation, and I think good set of points and discussions brought out by all the experts, and hearing you respond and give a sense that how this is all a part of a consultative approach where we are seeing the benefit of advocacy, we are seeing some of these reforms, and obviously there is some work to be done ahead, and that will be done. And I think on that positive note, as an industry, we take back a lot of feedback. We will come back to you with a memorandum where and where needed, we will be coming back to you for requests for meetings and deeper discussions on some of these issues. And thank you, Aseem. I think you didn't speak, but a lot of your hard work is reflected in the outcomes that we are seeing in the tax policy research unit. Thank you, Vivekji, for always being a supporter and looking at our issues with open mind. And of course, thanks Shefali, Mukesh for sparing your time coming over, Nidhi and Himanshu for driving the work with us on direct taxation, and Suchint, of course, for working on transfer pricing. So with that, we are completely out of time, but so well utilized. And thank you everyone for making this webinar a useful one. Thank you. Bye-bye.
Thank you.
Thank you.
For more content on tech and leadership, subscribe to NASSCOM YouTube channel and press the bell icon to never miss an update.